Joining us to talk markets, Sam Stovall, Chief Investment Strategist. We're supposed to all be in the Meta universe by now, according to Andrew. Anybody in the Meta universe?
No.
Zuckerberg.
Besides Mark, it's literally just Mark alone.
I've tried to get as an avatar Sam Stovall's image, but you have a copyright on that. I can't do that, can I, Sam?
No, just look over my shoulder, Joe, and you'll see my bobblehead. So I'll give you a nod to that.
Sam, are you bullish for the year?
I am bullish for the year, Joe. I have a 5,200 target for the S&P 500. You might actually say, well, gee, we're pretty close to that. So how can you be that bullish? But basically what we find is that after great years, and last year was a great year, the market tends to post good returns, meaning average gain of about 10%. And we've seen an improvement in the frequency of advance following a great year. So target prices, they might be adjusted, but essentially I regard them as weather vanes rather than laser beams, giving an idea of the direction and the magnitude, not necessarily trying to guess exactly where it'll close.
I mean, just saying we're going to close higher is in and of itself, that's taking a stand, Sam, and we get spoiled. What a year we had last year. And if you remember the beginning of last year, no one was talking about what the gains were going to be. Most people were talking about, how low of a low we were going to revisit. We saw 3,500 on the S&P. We saw some people down at 3,000. They don't have their jobs anymore, but
that's right. But actually, if they followed history, Joe, history said to expect about a 25% gain because we had a down year. We had an up January, and we had a Q1 low that did not exceed the prior December low. Every time that's happened since World War II, the market was higher 100% of the time with an average gain of more than 25%.
That's exactly what happened. And then, so you're looking historically at the year after something like that too, Sam, to get to...
Yes, exactly. We've got a positive indication from the as goes January, so goes the year in an election year. Average gain close to 16% with a 100% up move. Also, we just concluded January and February in higher territory. We have never posted a full year decline on a total return basis when that's happened since World War II. And only twice did we not end up in positive territory in the final 10 months of the year.
Well, unless we have, and it wouldn't be a surprise, we haven't had volatility in a while, but unless we have no volatility, to end up with your year-end target, I guess we could go higher, we could go lower. How do you see it playing out? When do you see weakness being manifested, even though we close higher? When do you see like a bit of a pullback?
Well, history says we should be getting ready to pull back because we recovered all that we lost in the prior bear market on January 19th. Traditionally, we advance about 2 months, gaining about 5% plus. And what we have gained so far since January 19th is the third highest of all post-bull market recoveries since World War II. So we're about due for some sort of digestion of gains, but I can offer some encouragement in that the average decline is about 8%. And we have not had a decline in excess of 14, meaning we don't typically drop from exhaustion into a new bear market, but rather into what I call a pullback, which is a 5 to 10% decline before then continuing to move higher.
What's your just overall view on what kind of economy this is, Sam? Is it strong? Is it strengthening? Some people think it's strengthening. Other people think that eventually you're going to see some cracks and the prospect for rate cuts later this year.
Right. Well, I think the economy is in a good position right now. Our expectation is for a sub 2% growth, Q4 of 24 over Q4 of 23, not surprisingly, because I think that the Fed will be slower to lower interest rates, meaning the first cut will come in June. We'll probably see 3 25 basis point cuts this year, one in each quarter. Unemployment might approach the 4% level as we move into 2025. So I would tend to say that things are going along quite smoothly. And what really would interrupt this market advance is probably an unanticipated event, which, as you know, Joe, are hard to anticipate.